This, as I say, is somewhat unrealistic. You can't be that consistent. You can't make $500 every day. Nobody has a 100% up win rate. The other thing to remember on that, if you're saying, oh, I want to average $500 a day, look at it this way. That would imply that you will make $2,500 a week if you average 500 a day. Now, as a general rule, and this would be someone who performs pretty well, as a general rule, you can assume that you will have 3 up days in a week, 1 down day, 1 flat day. So on that basis, basically what that means is you will have 2 up days in a week. That's the entire P&L for the week. So if you want to be able to earn $500 a day and you think that that's what you want to try and average out at, really what you need to be doing is having up days that are in excess of $1,250. That way, on average, you'll pull out about $500 a day. So that's one of the first things to remember. Just thinking that you can achieve that isn't enough. And if you're only making $500 a day, at best, you might be making $1,000 a week. So just bear that bit in mind, that 500 is not really where you're aiming to get to. If you're making 1,000 a week, you're on 50,000 a year. Don't get me wrong, it's not an insignificant amount of money, but to go into trading, that's quite a significant. You're taking a lot of risk to achieve not much better than you could in many other jobs. The other danger of $500 per day, or 1,000, or whatever number you want to call it, is having P&L targets limits your growth drastically. What it does in particular is it limits your growth by making losing trades or losing days more significant. If you only make 500 on up days and you lose 500 on down days, you wipe out up days. What you want to be doing, and where traders perform best, is where they recognize that the day suits them. And by recognizing that you're on a day that suits you, that's where you generate performance. What I've done here as an example is I use 3 months worth of performance. And what effectively I did is I took all of that performance from a group of our traders, and the actual performance is the blue line. So you can see the performance over those 3 months. This summer period is around about 2.5 million. And then what I did is I imposed a daily target and daily stop and ran the numbers. So if you have a target with no stop, i.e. a $500 update, and you don't have a stop, you end up with the red. Over time, you'll lose money because the losses will hurt and they'll take away from your upside. If you have a stop and a target, you still get some profitability, but this is far limited compared to what you would get if you had a much wider stop and wider target, i.e. no stop, no target, which is essentially the blue actual performance. And then if you have a stop on the day and no target, that's the way you perform the most. And you can see it evidence there. You set a stop and you let your winning days go, i.e. you try and push this as much as you possibly can. Your goal on any given day is not to hit 500 and say, well, that ticks off the consistency box. Your goal on any day is to make as much money as you possibly can. What you don't know with trading, as I talked about in the first session, is when that day is. That's what's the difficult part of it. And that's where consistency can be tricky, because some people are going to be good at certain things. As the first slide said, consistency is applying an edge time and time again. It's the consistency of application of your edge over a long period of time, not the consistency of achieving the same amount day in, day out.